What is up, YouTube? This is the Working Investor. In this video, we're going to compare and contrast two real estate investment trust option ETFs that on face value look very similar, but when you pop up the hood and look under the hood, you're going to see some varying differences. And the two funds we're going to compare is RNTY, RNTY, from YIELDMAX. I got to say, it's a very catchy name. And of course, we're going to compare it to, and this just came out a couple days ago, and we're going to compare it to a NEOS product, which also provides around 12% dividends, or aims to try to get around that amount. And that came out just a couple months ago, and that's called IYRI. Let's get into the video. Remember, nothing here is financial advice, tax advice, legal advice, or any other advice. This is for fun and entertainment purposes only. Please speak to who you must speak to. So I'm sure you guys could read. I'm not going to read all of it, but you could see that this new fund, RNTY, RNTY, the Target 12 trademark name. They're trying to get 12% yield, and they're going to try to basically own some REITs, real estate investment trusts, and do an option overlay on top of it, specifically talking about cover call strategy. Just looking at the overview of the fund, now here's one of the key things, pay attention. They try to look for 15 to 30 real estate companies. So the quantity is not too large when it comes to diversification. A decent amount, but not too crazy. And you already heard about the 12% that they're trying to do cover calls. We already mentioned that. And some room for capital, a little bit of capital gains through the REITs. Now here are some key details here. So it came out just recently, like a couple days ago, 4/16/2025. Now look at the expense ratio, 0.99%. We're going to talk about that a little later. And now let's pop up the hood and look at the holdings, because the holdings gives you a really good picture of what's going on. So if you pop up the hood, you could see here are the holdings. So it starts from line 2 and it goes till line 55, because line 56 is cash, and so that's basically 54 things that are going on, and each one has a cover call. You'll see AMT cover call, AVB cover call. So 54 divided by 2. So they have about 27 holdings, and they're doing 27 different cover calls. And notice something here, and we'll talk about this later. Focus very carefully that they actually write the cover calls on each and every single fund itself, not on a type of ETF or index of REITs. Just notice that. So you see, and let's look at the, basically so they have, let's say, 571 shares of AMT, and they're selling 5 contracts against it, right? And you could see, let's look at the, the expiration. So if you look at the bottom over here, it says 5/16 right here on the bottom, 2025 is the expiration. So it's about a month out, more or less. And it's a call of a 230 strike price. Now, this was just put on, right? And you can see here the price is about 222.66. So it's about about $7 or $8 about $7 out of the money, let's say, right? $7 out of the money. So let's say easy math. That's 7%. If it's a $100 stock, it's about 3.5, a little under 3.5%. That's a decent amount to be out of the money. So you're giving the stock about 3.5-ish% upside potential of NAV increase, and you're getting deriving some income. We could look at the second one as well. So let's look at AVB, right? Avalon Bay, and they have 500 shares, and they wrote 5 contracts against it, and you could see the same expiration. It's like the monthlies, and you could see here the call, C for call, 210 strike, and it's probably was trading around this amount, so it's 203.38, so it's about $7 out of the money, also around 3.5-ish% out of the money. I would say that's decent, giving yourself 3.5% upside appreciation in a month. Hey, if you had 3.5% appreciation in a month, times 12 months, that's pretty good. But not every month it would go up, and some months it may go down, and some months it may blast through it and the strike price, and you may leave something on the table. But at least you're getting a little bit of potential upside, not sub 1% like we've been seeing. So I have to say, I kind of like that. But there is a call against every single stock that I see here, which I understand because they're trying to derive income, right? Now the question is, of course, it's kind of new, and of course we're going to see if it's actually going to be 12%. Maybe they're going to derive more than 12%, maybe less. They target 12. Are they just trying to get 12% just to hit that target and then give the fund enough NAV, as much NAV as possible, as much room to grow? We shall see. Let's move over to our NEOS friend that's been around for a couple months, and their expense ratio, instead of 0.99%, it's 0.68. So it's about a third cheaper, okay? And they're still aiming for around 12% yield, and they're also paying monthly. I think the RNTY pays monthly as well. So you're getting around the same yield, same frequency of payment, but you're paying a cheaper price to the fund manager. So that's a cool thing. And they've been around longer. And NEOS, I'm a little bit biased, but NEOS has a little bit of a better reputation when it comes to giving the ETF room for NAV growth, They do have that, I'm not a hater, but just, I recognize that. And I'm sure you guys can read about, just a summary. The fund seeks to distribute high levels of monthly income through a data-driven option strategy on an ETF. So basically they use an ETF that's been tried and true, and it's been proven for many years. So at least you have the basket that they hold. You could track that, because that basket of IYR, and I have a video I'll link that I made about the whole review of IYR, and I compared it to an IYRI as a derivative of that, and I compared the IYR to many other very big baskets of REITs out there, like the VNQ, the Vanguard, REIT ETF, USRT, amongst many, many others. So I'll link that in my description. But basically, let's take a look under the hood and look at the holdings, and that gives you a big picture of what's going on. Again, looking at the holdings is where the sausage is made. That's where you see the magic happen. So to the novice investor, not looking at the holdings, especially with an option ETF, you're not seeing what kind of strategies they're doing. Even a regular ETF, if you don't look at the holdings, you don't understand the different types of assets they contain and the allocation of each asset. So that makes a big difference. So if you notice something very key difference here, look at the top two lines. So you see the top two lines is that they're selling calls against the index, the IYR index. That's what they're selling the calls for. And then if you look at after the second two lines where it says ADC, all the way down to the end of their holding, to 68, there's no cover calls against the individual assets, right? And that's from line 4 to line 68. So that means 4 minus 68 is 64 holdings. So you're getting 64 different holdings plus an option overlay on the index, which is a separate thing, versus 27. So you're getting much more diversification, right? And YIELDMAX charges a higher expense ratio, but they put in a lot more work because they're doing options on every single underlier versus just the top two lines. They just do options on the index. So I get that's fair. They do a lot more work for you. But is that work worth it? Because if you look at the top two, right? So you see here they have the 98 call. They staggered it, and they have the $100 call, and also expiring May 16. And in my other video I mentioned, I heard from their video that they do about 30 to 45 days out to expiration. And if you look at IYR right now, and you could look at the past, I don't know exactly when they put on these trades. Let's assume sometime in the past month. So, $98 is very close to the money. If they put it before April 2nd, they're like $3. Well, actually, that's about 3% out of the money. That's competitive, because we're talking about a $200 stock or a $100 stock. And since the market went down, you don't have to worry. You're really far out of the money. But the good thing is the market has a chance to, you have a lot of upside. So all this upside from the bottom of 83, when IYR went all the way up to 91, you should be able to capture all that upside because there's no capped upside until you get to 98 and 100. They stagger it. So you have actually, now that I'm thinking about it, they do stagger it. So from 95 to 100 roughly is a 5% difference. And so they're doing about 3 to 5% out of the money. So they're giving you more room of growth. And here's the kicker, and this is what I really want to bring home to you guys. The option overlay allocation, look at the weighting. It's only a tiny percent of the portfolio. It's maybe 0.11 and 0.05. So, but then they own all these underlyings, some of you guys may be familiar, like AGNC, which I'm familiar with, but those who do a lot of REITs, who doesn't know O Realty? It's here, O Realty, right? They have all these underlyings and they don't have any capped upsides. So all the single stocks have no capped upsides. And it looks like a tiny portion of the portfolio does have capped upside. And that capped upside has more wiggle room, or comparable or more wiggle room. So if you're truly going to get 12% yield on both of them, this is how I'm thinking. Maybe I'm thinking wrong. I don't know. Why would I not want to give myself the most chance of upside? Let's do a comparison of total returns of IYRI to IYR since inception. Let's take a look. So just to zoom out really far, let's look at the 5-year chart from Seeking Alpha. We're looking at total returns. I'll compare the classical VNQ, the Vanguard Total REIT Index. 5-year return, total return 36%, IYR 35. So it's about the same. And then IYR came out around, let's say, I think it was around, let's say January 15-ish. Let's take a look. Okay, I got everything set up over here. So from January 15, VNQ total return, and of course the market's been on a death spiral and very choppy. VNQ is only down a little bit, 0.18%. IYR, which we're going to base it as our baseline for IYRI, it has a positive return of 0.47 since January 15th, and IYRI has beat the underlier. I know it's a very small amount, but it's almost double, but it's outperforming the underlier. Basically, RNTY, we don't have much data, so we can't really see, but at least you could have an idea of what it's based on. You know what I mean? And it's beating the underlier with this option, which makes perfect sense. So my summary sheet that I'm going to show you right now, we'll go one by one. So as far as reputation, I'm biased and it's subjective, and I'm not a hater. I just, subjectively, NEOS has a better reputation when it comes to the NAV, when it comes to, they just have. YIELDMAX has to get that reputation if they want to prove it to their investors. As far as the target yield, they both target, as you saw, around 12%, but time will tell, because theoretically, I would think if you're doing it on the single stocks versus an index, you should get a little bit more income to be derived, but time will tell. Expense ratio, NEO is the winner, as we saw. It's a lower expense ratio. Longer history, well, YIELDMAX just came out now, so NEOS has been around for a couple months. So we need to really track this. But so far, NEOS has a longer history, and it has a proven index, right? And it has more diversification, as we saw, 27 versus 50 something. We have much more diversification. I need to give credit to YIELDMAX, because YIELDMAX, it looks like they do own the underlying. This is not a synthetic. So it seems like they both own the underlying. Gives room for upside. Well, they both do. It's I only checked 2 of them. We got to go down the whole list and get an average, but they both do give a nice amount. I would say 3% is decent per month, not sub 1% nonsense, at the money. So they both give a chance to get some upside. And then the options do seem to come around monthly, 30 to 40, NEO said 30 to 45 days, so around a month out. For now, my verdict is I do have a position in IYRI. I want to disclose that I am sticking with my position. I'm not touching it for now. I might keep an eye out for RNTY. Let me know what you guys think. I know it's very early in the journey, and one day we'll look back at this video and we'll look back at the fun and we'll have a better idea. But what do you guys think? Do you guys have good, positive feeling about RNTY? Is there anything that you think is inadequate or inaccurate, should I say? Anyways, this is the Working Investor over and out. I hope you guys have a fantastic weekend. All the best.